So topic 2 is really the introduction. It really starts off the heart of the course. Okay, so the first month we're going to talk about what's colloquially referred to as costing. Okay, and the first part of that, you notice this topic is called an introduction to cost terms and purposes. So a large part of what we'll be doing in this chapter corresponds to chapter 2 of your textbook, is really laying down vocabulary. Okay, understanding sort of the conceptual building blocks, understanding vocabulary, terminology, and you'll find yourself having to use these vocabulary, think in terms of this terminology for pretty much the rest of the course. So it's really foundational stuff, it's fundamental. So let's first motivate what this costing is all about, and let me try to give you an idea of why do we need to think about costing. And as we explain, it will become obvious what costing itself is in a moment. Okay, so let's do a thought experiment just to start things off. Put yourself in the shoes and the hats of a small business owner or an entrepreneur who's thinking of starting a small business of some kind. Okay, and let's make it more specific. Imagine that you don't think of an abstract third person. Imagine that you were about to launch, open a small restaurant in Newark. Okay, the kind that you would go and eat lunch at every afternoon. Okay, a small restaurant somewhere, Broad Street or Halsey Street in Newark. So, what are the different things that you need to do in order to get your enterprise off the ground? Well, at the very beginning, before you even start actually getting into action, you need to do a considerable amount of research, right? Market research. You will want to find out about what kind of market would you be catering to, what are the different potential markets out there in a place like Newark, right? There are broadly two kinds of markets. There are students at Rutgers, and then there are office workers, right? This is also an office park. There are people working in large corporations sitting on the top 5 or 6 floors. So identify, find out a little bit about each market, right? That's what you would really want to start out by doing. How large is the student market? How large is the office goers market? You know, what kinds of food are these people interested in eating? What kinds of price ranges are realistic for them? And so on. What times of the year, you know, do the markets ebb and flow? Some markets could be seasonal. So, for example, if you want to cater to the student market, and the students aren't going to be around that much during June, July, and August, the months of the summer, right? So you want to start out by finding out a little bit about the market. So let's imagine you do all of this research, you find out about all of these demographics, and you kind of form an impression about what kind of restaurant you want to open up. Okay? Let's imagine a lunch place that gives like soups and sandwiches or something like that, and coffee. So then you have to start lining up the finances. Really, that's sort of the next fundamental step, right? And what kinds of financing could you typically raise for a small business started out by an untested entrepreneur like yourself? Where could you go? Suppose you graduated with your BA 3 years from now, and you and your friends decided to get together and start a small business or a small store or a restaurant. Really, who would give you the money? Where would you go? You'd go to get a loan at a bank. The problem with that, that's the most commonly used source of financing. There's more problem with that is that banks typically want you to have some kind of business experience before they give you a loan. Okay, so it's a difficult chicken, but you know, you can't get that experience unless someone gives you some financing to begin with. So it's a chicken and egg kind of problem. Typically, when you're starting out very small, you tend to rely on some informal sources of financing. What I mean by informal is not something that happens through an institution, like you go to your uncle, or you know, you get somebody to basically take a risk on you. Okay? Sorry? Yeah, but that's by definition. Anyone who gives you money is an investor, right? So the question is, who would you go to in order to ask for investment? You wanted to say something? Yeah. So that would be another informal source of financing. You know, You look around, you come up with every last penny that you have, and you basically pull it together. You call up your friends, your uncles, your dad, and everyone pulls in a little bit of money to get started. That's how most small enterprises get started up. And then once you have a record of running for maybe 6 months, a year, then you can go to a bank and you're in a position to ask for a loan. So you line up the financing, and then once you line up the financing, then you're in a position now to assemble all your different factors of production. Right? What do I mean by factors of production? This is a term from micro. So can someone list for us, please, what the different factors of production are? So the capital is what we already have raised, right? And it don't interpret me literally in the sense that it doesn't happen in the strict sort of order. One thing happens after the other. You're kind of doing a little bit of everything at the same time. Okay, we're just trying to broadly sketch out the steps. So you assemble, you get a space, right? You hire people, you get equipment, right? You get tables, chairs, furniture, coffee maker, a grill, an oven, and all of that. And then you put all of that together. That's what we call assembling the factors of production. So suppose you have all the financing and all the physical elements in place. Okay. Now, there are some crucial decisions you need to make before you actually open your doors. Right? In a restaurant, what would those decisions be? Sorry? Yes. So you want to come up with and all of that is summarized in your menu. Right? We're keeping it very, very simple. This is stuff that we can all relate to and that we've all experienced firsthand or secondhand. Okay, so you want to come up with your menu, and that involves lots of smaller sub-steps. Right? You first want to decide exactly what you want to provide. Right? And then you want to decide exactly how much you're going to charge for everything. Right? You decide all your different products, your different product categories. You want to figure out how much you charge for everything, because the menu has to have prices also. So now the question is, how do you come up with these prices? Let's imagine you have some soups, some sandwiches, and some coffee. How are you going to go about coming up with the prices? Okay. So this is one strategy or one source of information that you could use as an input into your decision. It's a decision, right? How much to charge. So a very, very important input is you look around you. You look outside of you, and you look at who your competitors are, how much they're charging. You write down that information, keep it at the back of your mind. Okay? So that's external information. Right? It's not related to you. It's related to what everyone else around you that interacts with you in some way is doing. Now, is that the only source of information that you need to take into account before pricing your product? Is that the only source of information? If not, what are the other sources of information? Okay. So the issue with that is you cannot get a sale. You understand that price and demand are functions of each other. So you cannot get a sales projection until you figure out exactly what price point you want to be at. So that's normally something that comes afterwards. And once you figure out your sales projections, you put it back in, and then you revise your estimates a little bit more. Okay? So what other piece of information? We have competitors' prices. What else? Yes. Yeah. So one strategy is just to look at what everyone else is charging and go a little bit slower, right? What's the risk with that? The risk with that is that you might end up making a loss in the first few months. But you can say, this is what we need to do in order to get our foot in the door. Another way to do it, and I'm not suggesting that these are mutually exclusive. You need to do a little bit of both. Okay? You need to look not only at external information, but also look at internal information. And the internal information that's key to us is, what is it costing us to supply each of these product categories? How much is it costing us to make each type of sandwich? How much is it costing us to make each type of coffee that we're serving? And to understand why this is called internal information, right? Because it's a function of how you do things, how you set up your kitchen, the efficiency with which you run things. Okay? But you understand that this is a very important piece of information, that you really cannot determine a price until such point as you know what your costs are of creating and supplying each product from beginning to end, right? So how do you balance these two pieces of information though? Suppose you estimate that the cost of making a standard coffee is coming out to 70 cents per cup. Suppose your competitors are, charging some different prices, say 60 cents per cup. How do you balance internal and external information out? So it would depend on exactly what product or product experience you're giving in total to the customer, right? So suppose you have a very standard product. It goes back to our discussion last week about strategy. Remember this? Suppose you have a very standard product, something that's very replicable. And what I mean by replicable is an experience that the customer can replicate for himself very easily. Or something that's very substitutable. Something for which there are close substitutes available in the market. Well, then you need to place a little bit more importance on the external information. Because, why would anyone be willing to pay anything more for something that they can get at the same effort to themselves at a lower price, okay? So then you need to put a little bit more emphasis on external information. If suppose you supply something that's even a little bit different from what your competitors are able to give, and that difference could arise from any number of things. It could arise from the product itself. It could arise from the environment in which you sell the product. Right, you create a very nice ambiance in your restaurant, or it could arise from the types of ingredients that you use. It could arise from the location. Location is also an important differentiator, right? If it's even a little bit different, that entire experience from what someone else is offering, you need to have an understanding of your own costs, because you realize you're really striking out into virgin territory. So you're supplying something that has not been supplied to the market before. So you really need to emphasize internal information in coming up with a total cost first, and then use that cost to come up with a price that will earn you a profit or a margin of some kind. So I hope you understand now why it's important to cost things. We'll figure out exactly how much something costs us to make or produce or serve or supply. Right? That's really one of the fundamental decisions that any business enterprise will make. It's a little easier to understand it in terms of an enterprise that's just starting up. That's why we use that example. Okay? But it's really not just something that you use when you start up. It's also a decision that you keep making on an ongoing basis. Even if you need to revise your product costs, look at what new things your competitors are doing. So it's something that you need to keep doing all the time. Okay? But that's why it's important to have an understanding of cost. And costing is essentially the science or the art, however you want to look at it, of figuring out exactly how much it costs you to supply products and services. Okay? So you will notice that your textbook is called not managerial accounting, curiously enough. It's called cost accounting, a managerial emphasis, right? And the reason for this is because costing is such an important part of managerial accounting that many people use the term cost accounting to refer to managerial accounting. Okay, so managerial accounting and cost accounting refer to one and the same thing. Okay, and you will also hear the subject being referred to sometimes very colloquially as just costing. Okay, so don't be misled by this. Costing is not the only thing managerial accountants do, but it's a really large chunk of it. Okay, so we'll use the two terms interchangeably as we go on. So before we even get into the topic of costs, let's try to first make sure we understand what the term cost means. Okay, so we define it in a very simple way. Now, the cost of anything is simply the value in monetary terms of the resources that you're required to sacrifice in obtaining that thing. Okay, so let's suppose you're renting a warehouse. Okay, and the warehouse is being rented out for $3,000 a month. Okay, you're basically sacrificing those $3,000 to that particular objective. You're foregoing the opportunity to use that $3,000 for anything else, and therefore that is what the warehouse costs you. Okay, now what are the costs to you of sitting in this class? What are the costs to you of taking this class, of taking intro managerial? Notice I say costs, not cost. I'm looking for more than one item. So that's one cost item. There's a more sort of direct, tangible cost related to being in this class. It's not free, right? money. So that's normally the first thing that most people would think of, right? So there's a tuition that you pay, so that's a very direct, measurable cost. It's expressed as a particular number. It's given to you, and it's a dollar cost. Now the second one is no less important, but something that we tend not to think about so much, is the value of your time, right? So the value of your time, so you could say this costs me, average is $1,000 for the credits and then 3 hours of my time. So you understand that costs can be in terms of resources other than just dollars. A cost could be incurred in terms of any type of underlying value. It doesn't always have to be a direct dollar cost. Okay, but in order to make numbers easy for us to work with, we always translate the cost of any resource, whether it be time or be expressed in units of something else, always into dollars, because dollar numbers are easier for us to work with. Okay, so how would you translate the cost of your time, the 3 hours that you spend here, into a dollar amount? You look at what you're sacrificing or giving up in order to achieve this objective, right? And you're sacrificing, maybe if you're making $20 an hour doing something else, you're sacrificing 20 times $60, right? So if you have an alternative place that you would be at that gives you a very specific amount per hour, then it makes the calculation easy. Sometimes there's no easy number, so we have to come up with our own estimate, right? So you have to treat that estimate with a little bit of uncertainty that it deserves. So costs can be incurred in terms of all kinds of resources. We always try to translate everything into dollars. Okay. So the second piece of terminology that I want to introduce to you before we jump into our first cost classification is the idea of a cost object. A cost object is a very simple term. Now, cost object is simply anything for which we want to come up with a measurement of costs. Okay? So suppose I run a furniture factory and I make these chairs. Okay? And I want to estimate, I'm trying to price this particular product. And I want to estimate exactly what the costs are of making one piece of this product. So then one piece of this product is my cost object. This thing is my cost object. Okay, so anything for which you want to come up with an estimate or a measurement of costs is your cost object. Okay, so most commonly your cost objects are individual units of whatever product you are selling or whatever service you're providing. Okay, now cost objects could be more general. It could be other things. Remember, cost object is simply anything for which you want to measure costs. So suppose I want to figure out the costs of, suppose I make 1 million chairs in a month and I want to figure out the cost of that entire product line, that entire line of chairs. And my cost object would be that entire product line, all the units of that type of chair that I make in that particular month. Okay? You understand that the process of estimating the cost of one piece of this chair, of one piece of this type of furniture, and the cost of estimating and the cost of estimating the entire product line are essentially the same mathematical calculation, right? Suppose you make 1 million chairs, you first figure out the exact costs that go towards making this type of furniture for that whole month, and then you take that cost and you divide it by the volume, the number that you're making in order to estimate the cost of one piece. Okay, so cost objects are most typically your products and services, but they can be other things. So suppose you are a manager and you're asking, say, the following questions. So how much does it cost us to make our new snack mix product? Okay, so that's the most common kind of question you find yourself asking. So that is an example of a product being your cost object, right? Or if you want to ask, how much does it cost us to operate the welding machine? So this is not a product, right? This is a particular machine that you use inside your facility in order to produce a product. But you could want to analyze the costs of operating that machine because you want to figure out, for example, how efficiently you're operating that machine, right? So then that welding machine becomes your cost object. So cost object could also be a particular asset that you own within the enterprise. Or if you want to ask, how much does it cost us to operate the customer service department? Because, you know, a customer service department is not a department that usually generates revenue. right? A customer service department is purely a department that creates expenses or costs, right? So a cost object could be a particular department or division. It could also be how much does it cost to run the Newark, New Jersey store, a particular geographical location. A particular service that you provide within the company, or even somebody asked the question, how much does it cost us to supply to Walmart? Now, Walmart is one of our customers, okay? You could even have a particular customer being your cost object. Because let's suppose, for example, that only in supplying to Walmart, you need to actually go and make the deliveries yourself to some far-off location. So there are some specific costs associated with this customer that you need to track that don't relate to other customers. So a cost object could be a product, a location, a division, an asset, a department, any entity, any carefully defined thing or entity for which you want to estimate cost. Okay? So now that I hope you understand what a cost object means, we're in a position actually to start talking about the very first classification of costs, actually the second classification of costs. So last week we looked at classifying costs based on what? We looked at one way to classify costs on Thursday last week. What was that classification of costs that we looked at? We looked at how to classify costs based on which part of the value chain the costs were coming from, right? R&D, design, production, marketing, distribution, and customer service. Thank you. Right? So what we're going to do really for the rest of this chapter is to understand very many other ways of looking at costs based on some other dimensions or some other characteristics that those costs have. Okay? So again, let's take an example. Let's continue with the example of the restaurant. Okay? But instead of using a fictitious restaurant that we aren't able to visualize, let's actually think about the restaurant downstairs. Okay, we all know what it looks like, right? So they have many different product lines. You could call it, right? They have a soup, they have a salad bar, they have sandwiches, a pizza, they have a coffee bar, right? So let's suppose that we are trying to assess exactly what the costs are of running that coffee bar for some period of time. Okay, you can imagine a week or a month. Okay, so in this case, this coffee bar downstairs, you can all visualize exactly what it is, right? Is our cost object, because that's the entity, that's the thing for which we want to estimate cost. Now you realize that each of these is another potential cost object that exists within the same enterprise. Okay, but for the time being, this is the one that we want to focus on. And we want to try and estimate all the costs that are associated with running that coffee bar. So let's list them in no particular order of importance. Try to visualize and describe to me all the different costs that are related to running the coffee bar. And anytime you start doing a listing of costs, you can just tell me whatever items strike you. Okay, it doesn't have to be in any order of importance. But a suggestion that's useful is anytime you're trying to list the costs that are associated with something, it's always useful to start out with the most physical costs, most tangible costs first, that are closest to the physical product, and then go to relatively more and more broader things. Okay, so who wants to go first? The coffee beans, right? Most physically, tangibly related to the product. You mean the cans? okay? The cups, sleeves, all the accessories, right? This includes the sugar, the spoons, and all of that. And then we'll go one item at a time, please. Okay? Okay, Jennifer, you have your hand up. Coffee machines. Now, there's a number of costs associated with running with the coffee machine. So it's important to realize that there is more than one cost item. So there is the cost of actually buying the machine, right? So that's what we call a capital cost. That's the cost to buy. And then what are the costs, apart from the actual cost to buy? The operating costs, right? Yeah, operating costs, which include any supplies that you need to fill in regularly, repair, maintenance, coffee beans, water, okay, other items. Yes, for sure. It certainly loses value over time, right? And that is a cost that you. Yes. Yeah. Yes. So there is some cost that you're implicitly incurring for really wear and tear. Yes. Yes. Technical obsolescence and so on. So that's another part of the cost. So what other items? I said start out with the items that are most physically, tangibly related to the product, and then start thinking about the other items. Imagine yourself to be a fly, and you first zoom into the cup of coffee, and then now we're zooming out slowly. Okay. Okay. This is it. Okay. This is it. These are the only costs associated with running the coffee bar, or there are others. Employees. So let's talk about that, right? So when you think about the setup downstairs, is there a dedicated person who's just servicing the coffee bar? There isn't, right? There's somebody who's running around and basically checking customers out, making sandwiches, and then every once in a while comes and looks after the coffee bar. So keep that in the back of your mind, okay? But when we think about the cost of employees, we're really thinking about the cost of their time. And that's paid for in the form of wages. Okay, so this is the way in which we express that cost, and then also other things like benefits. Okay, what else? Any costs that could be related, that are economically related to running this coffee bar. Okay, so potential, I don't know, and how do you shield yourself from liabilities? You don't take out things like insurance, right? So that could be, and other ways of shielding yourself against liability. So what else? Are these the only costs that you incur in the process of running that coffee bar? This is not even close to being a comprehensive list. Fine, go ahead. Now, we haven't introduced the term overhead, right? So I prefer not to use it until we actually figure out what that is. But I want to look at the second thing that you said, which is, so it's important to understand exactly why this is included here. I asked you to come up with all the costs that you incur in the process of running that coffee bar. And rent is certainly something that you would have to pay in order to keep that coffee bar running. You agree with me on this, right? You wouldn't be able to keep that particular cost object alive and sustain it unless you paid out some cost for the space that's in. Now, naturally, the whole of the rent that's paid out for that facility on a monthly basis is not incurred solely for this cost object. Everyone agrees with me on this. But some portion certainly is, right? So rent. And then once you think about rent and put it here on this, there are a number of other costs that are just like rent that you realize also need to go on here. Okay? And these are other costs that are related to just keeping that facility alive, like licenses. You may need to have some kind of food, like a restaurant operating license, and other things like fire insurance, employees insurance. What other items are we leaving out? We'll come to that. Okay, we'll come to that later. It's absolutely true. It's absolutely true. We'll come to that, okay, in a moment. Okay, anything that's not on here, let's not talk about items that are closely related to stuff that's already here. Yeah, okay, yeah. Just maintenance supplies, right? Like cleaning and maintenance supplies, let's call it that. Maybe security. You know, not in this particular restaurant because there's a common security, but if you were running like an independent storefront of your own, you would have to have some security. Yeah, very good. Okay, I think we have a fairly comprehensive listing. Okay, so now let me ask you guys a question. This is a very easy question. Just don't overthink the answer. Okay, so why did I put some items on the left and some items on the right? Okay, what is it that distinguishes the items that are on the left? What is it that unites all of these items? What is it that unites all of these items? And what is it that separates this group of items from this group of items? Everyone understands the question. Take a moment to think about it. Okay, what is it that distinguishes these costs from these costs in that particular organizational setup? Take a moment to think about it and then tell me your answer. Really? So which is which in your mind? You could be right. Okay. Okay. You know, you could be describing the way that some enterprises are run, but this is not it's not a general truth, right? You could think of examples of enterprises. So suppose I'm the owner, I'm the manager. Like, you know, we were starting up a small restaurant. That distinction wouldn't apply, right? So I'm asking for a distinction that applies generally. It's sort of a general truth. How so? Could you explain? Now, you guys would all be describing stuff that's true in many situations. We're looking for one particular distinction because that's what we want to talk about today in class. You want to think about it a little bit more? Okay, all right. You, sir, at the back. Okay, directly related and indirectly related. Does anyone want to elaborate on this a little bit? Does anyone want to elaborate on this a little bit? I'll let one of you go. You guys take this. This is related to actual coffee making, or this is related to imaginary coffee making? Okay, very good. That's exactly the thought that I want you guys to all hold, okay? It's a very simple distinction. I told you not to overthink it, right? So let's put down some facts about each type of cost. Now, all these costs are here only because of one thing, because they are related to the cost object. CO stands for cost object. Okay, so just keep that in mind. So both types of costs are certainly related to the cost object. Let's create a little bit more room here. So both types of costs are related to the cost objects. And what does that mean? That means they necessarily have to be incurred if you want to make and supply that cost object, right? You really couldn't. You don't have the option to create this cost object unless you incur every single one of these costs. That part is clear to everyone? So each of these costs are necessary in order to produce and supply that cost object. Now, the key difference is when you look at these costs, keep in mind what the cost object is. It's the coffee bar. every single dollar of each of these costs is directly attributable to the coffee bar cost object and only to this cost object. Everyone can see that? So every dollar of these costs is attributable only to our cost object, the one that we're interested in. Or another way to think about this is every single dollar of these costs is attributable uniquely to this particular cost object and not to any other cost object, right? Whereas, if you look at these costs, these are also certainly related to the making of that cost object, but are they related exclusively to this cost object? What do I mean by exclusively to this cost object? Are they related only to this cost object to the exclusion of the other cost objects that exist within the enterprise? Obviously the answer is no, right? You see that applies to every single one of those items that we put out there. So every dollar of these costs cannot be uniquely traced or identified or associated only to this cost object. Okay? Another way to think about it is, when you look at these cost items are incurred not by a single cost object exclusively, but usually jointly by many different cost objects. And you agree that that's the case here. All those costs that we put on the right are incurred jointly by all of these cost objects here. Okay? The distinction is absolutely clear. Now, so these costs are what we call direct costs, and these costs are what we call indirect costs. Okay, so that's the first piece of terminology you need to know. You understand this is a very different way of looking at costs from the R&D costs, design costs, production costs, that way of looking at it that we looked at on Thursday. So indirect costs have many different names. They are also commonly referred to as overhead or overheads. This is a term that you all know and which we also tend to throw around, but now you know exactly what it means. They are also referred to as joint costs for obvious reasons, or because they're incurred jointly by many different cost objects. It doesn't have to be many, it just has to be more than one. And then sometimes they're also referred to as, there's so many different names. Capacity costs. Okay, we'll talk about the other terms later. Okay? So that's the first distinction. So really the best way to understand this distinction is to think of many different examples in many different contexts, and that's what we're going to do now. So you want to pick up your handout. I put a number of sort of scenarios there, and let's do a little bit of practice in thinking about direct and indirect costs in each of those scenarios. So the first example that I put on there is a pair of Levi's jeans. Okay, so this is at the bottom of page 2. So let me explain the scenario to you a little bit so you can visualize it. I imagine a Levi's factory that makes many different types of products. It makes jeans, pants, shirts, boots, hats, and so on. Okay, so what we're interested in, let's say, is a particular type of men's jeans, a particular brand of men's jeans. That is our cost object. Okay, so what are some examples of direct costs of that cost object? The material, the accessories that go into making it. Other examples of direct costs would depend on how everything is shipped, right? If products are shipped by brand, could be a direct cost. If products are shipped by customer, you understand what I'm saying? It need not be a direct cost. We want to think of things that are very obviously and straightforward direct costs. Sorry? What do you mean the style of the jeans? Yeah, how's that a cost? That's just a characteristic, right? It's not a cost, right? So another example of a direct cost could be, imagine there is assembly lines that are making each type of product, and there are going to be workers that are standing on each assembly line supervising the cost, the item that's being produced, right? And these guys are being paid by the hour. And so the workers who are on that particular assembly line, that particular brand that we're looking at, the cost of those workers, the wages paid to them, benefits is also a direct cost. Now, visualize that facility with this brand and with many other brands inside it. How about the rent that's being paid for that facility? Is it a direct cost or an indirect cost of our cost object? It is an indirect cost of that cost object, right? And any other facility-related costs like the insurance, the security, even the wages, the salary that you pay the supervisor that's responsible for supervising the entire factory floor, you recognize that his salary is also an indirect cost of our particular cost object. Okay? So I hope that gives you a little bit of an idea of how to get started with thinking about this distinction.
The only purpose of that business
Okay.
So wouldn't rent be directly?
Yeah, certainly. Yeah, but here's the situation I asked you to visualize. Imagine a Levi's factory, okay, that's making the entire range of products. Shirts, jeans, hats, boots. Our cost object is one particular brand of jeans. The rent is paid for the particular brand of jeans, or the rent is paid for the facility that makes our cost object as well as many other cost objects. No, that's not the issue here. The issue here is that the rent is being paid at what level? Is it being paid at the brand level, or is it being paid at the facility level? At the facility level. And so therefore, is that entire rent being incurred only for our cost object, the one that we are interested in, or is it being incurred jointly for many different cost objects? So that's the thinking that you have to have in order to make that distinction. Is that clear to everyone? Okay, let's look at the second example that I put there, an audit done by a CPA firm. Okay, so let me explain to you what this means. But before that, how is this different from the previous example that we looked at, from the Levi's example? How is this business itself different? The business of a CPA firm is different from the business of a Levi's factory. How? It's a product, right? The difference between a product and the service. The product, you make something tangible. The service, you don't make something. So you offer something intangible. Okay, so here is how CPA firms work. They have a number of people, some of whom are studying to get their CPA degree, some of whom already have their CPA degrees. And and one of the things that CPA firms do is audits of other firms. They go to other firms who are their clients, and they examine their financial statements. Okay, and they check their financial statements to make sure that there is no fraud or misrepresentation anywhere on the financial statement. Okay, so basically they verify that each and every number on the financial statements is correct. Now, as you may imagine, this is a highly seasonal business because all firms produce their financial statements at about the same time. Okay, so there's a small team of CPA. Will maybe be a team of consisting of a number of juniors and then a couple of seniors who are assigned to every audit, who actually physically go over to the customer's factory or office or whatever it is and do the checking. Okay, so let's imagine that our cost object is the audit of General Motors. Okay, so one particular audit, that is our cost object. So we are PwC, we have hundreds and hundreds of clients like General Motors. Our cost object is the audit of General Motors. Okay, so what are some examples of direct costs of this cost object? That's the primary cost, really. Everything else is really marginal, right? So the number of billable hours, the number of hours really that the partners, the managers, and the juniors are putting in. And how do you keep track of this? Typically, there'll be some kind of timesheet system or software, right? And each person will have a rate at which they bill. Partners will bill at $1,000 an hour. Juniors will bill at $100 an hour. So that's really the primary cost. Other examples of that, I didn't make up that number. It's true. Other examples of direct costs mean small things like gas for driving to and from the customer's office, the cost that you pay for, your employee's lunch at a restaurant while they're there, and so on. So let me ask a question now. How about the cost of, now every one of these auditors will have a laptop, right, that they take to run their calculations and so on. How about the cost associated with that laptop? Is it a direct cost of this cost object? Why is it indirect? Sorry? Certainly not. But that's not related to, that's not something that's relevant to the discussion. Well, you certainly don't purchase laptops on your own. It's invariably corporate laptops. You aren't allowed to have confidential client information on your person. Yeah, it will be company supplies. Yeah. So is it direct or indirect for this cost object? And imagine how it works. You're an audit. Let me explain to you how it works. You're an audit junior. You start your internship with Deloitte in June. On the day on which you go in, you go through corporate training. You will be given a corporate laptop, okay, with a password and the firewall and all of that, and you will basically cart it with you to all the audits that you're assigned to. Okay, that's how it works. So now tell me, is it a direct cost or an indirect cost of the GM audit? It's an indirect cost of the GM audit because you don't purchase a laptop for the GM audit, right? It's corporate supplies. It's just like printing paper or it's like this stuff. The stuff that you necessarily need in order to keep the business running on a day-to-day basis, right? So the cost is incurred jointly by the GM audit as well as by the audits of all the other clients that this person is servicing at that point in time. So it's an indirect cost of this particular audit. How about the accounting software? So typically, auditors' laptops are loaded with specific types of auditing and accounting software that that have different types of fraud detection modules built into them to help them detect fraud and so on. But suppose you pay for that software on a subscription basis. Okay, every year you pay $500 or so on. How about that cost? Is it direct cost or indirect cost? Who says direct? Who says indirect? So could I hear an explanation from anyone who thought it was direct? Yeah, so I did tell you that you pay for it on a subscription basis, let's say $500 a year. Okay, so I tell you that information for a reason. So if you pay for it on an annual basis, and you're basically taking that service with you in using it in order to run your client's numbers for every client that you go to, then it ceases to be a direct cost of any client. It's an indirect cost. Again, it's like the cost of supplies, right? How about the salary and benefits that you pay to the secretary that's coordinating the assignment of personnel to various clients? Clearly indirect, right? Not exclusively incurred for any particular client. So, and you should be able to think of more examples of each type, okay? I put one more situation there. Sports Illustrated magazine published by Time Warner, okay? So Time Warner is a media company. They have a family of different magazines that they publish, okay? So we're looking at one particular magazine, let's suppose for a period of, say, a year. Okay, so the 12 issues of Sports Illustrated is our cost object. Okay, so how about the cost of the wages paid to the in-house photographer and the stylist that service all the magazines in the Time Warner family? Indirect cost, right? And you can think of other examples of indirect costs and other examples of direct costs. Okay, so now one thing that should be clear to you from the examples that we looked at, we'll talk about it in detail, but just a hint of things to come. This classification of costs into direct and indirect is very much relative to what cost object you pick. Okay, you all see that. Can you classify costs into direct and indirect without defining what your cost object is first? You cannot. Right? So the classification of costs into direct and indirect is not an intrinsic or an inherent characteristic or a quality of each cost. Okay? It's only a classification of each cost relative to any particular cost object that you pick. Suppose I change the cost object to something else. A cost that was a direct cost with respect to this cost object, you understand, could become an indirect cost with respect to some other cost object. Okay, so the classification of costs into direct and indirect is entirely relative to a particular cost object or with respect to a particular cost object. So unless you have defined your cost object very clearly in your mind, you will not be able to describe costs as being direct or indirect. Okay, so don't make the mistake of trying to do that classification without understanding very clearly what the cost object is that you're trying to describe. Okay, so let's actually put some of this theory to work and do a couple of exercises from your textbooks. Okay, so the first exercise that I want you guys to think about is 220. It's on your packet, and this is a classification of costs for the manufacturing sector. Okay, so take a minute to read the description. Okay, exercise 220. Take a minute to read the description and start thinking about the first few options. Okay. So what we're interested in is the California plant of New United Motor Manufacturing, that is a now defunct car manufacturer, who assembles two types of cars, okay, the Geo Prism and the Corolla. Separate assembly lines are used for each type of car. Now you should pay attention to all this descriptive information that tells you about how the organization is set up, okay, because it helps you to understand exactly what the cost object is in this case. Now we have this facility, right, and we have two types of cars being assembled inside the facility. We have a Geo Prism and we have a Corolla. Now, what is the cost object? The cost object is each specific brand of car. So the brand, okay, each of those brands, that's our cost object. So now let's look at the first one, the cost of tires used on the Geo Prism. The direct cost or an indirect cost of the Geo Prism. The salary of the public relations manager for the NUMMI plant. Indirect, right? The annual awards dinner for the Corolla supplier. Yes, it is direct to the Corolla. But it is direct with respect to the Corolla, yes. How about with respect to the Geo? No what? So the awards dinner for the Corolla supplier is a direct cost of the Corolla cost object. But the cost of the awards dinner for the Corolla supplier is neither a direct cost nor an indirect cost of the Geo Prism. It is unrelated to the Geo Prism. Okay? That's why we're not even talking about the other brand. Our cost object is whichever brand is referred to in that particular description. You get it now? Okay, so that particular item number 3 is neither direct nor indirect with respect to the Geo, with respect to the other brand, because it's unrelated. Remember this. Very first condition is that it's got to be related. Okay, it's unrelated, it's neither direct nor indirect. Okay. The freight costs of Corolla engines shipped from Toyota City, Japan. Oh, I'm sorry. The salary of the engineer who monitors design changes on the Geo Prism. Direct with respect to the Geo Prism, right? Unrelated to the Corolla. Okay, and the freight cost of Corolla engines, obviously a direct cost of the Corolla, right? Let's look at the last two there. Electricity cost for the NUMMI plant. A single bill covers the entire plant. Indirect, right? Because of what? Because you are told that a single bill covers the entire plant. Now, suppose you had a separate metering system for each group of assembly lines and you got 2 bills. Okay, one bill for the Geo Prism group of assembly lines and another bill for the Corolla group of assembly lines. Then you realize that that cost would not be an indirect cost anymore, because you're able to break it down into two. It comes as 2 pieces, and each one of those pieces can be exclusively traced to one of our cost objects. Okay. The wages paid to temporary assembly line workers hired in periods of high production, paid on an hourly basis. Think about this one for a moment before answering. Okay, so let's hear from someone who says direct. Let's hear from someone who says indirect. Yes. Yes. That's a very good analysis. So actually this one is, we really don't have enough information to be able to conclusively identify whether it's direct or indirect. Okay? Now let's sketch out two alternative scenarios. Suppose you just had a pool of temporary workers and they were assigned randomly to either one of the group of assembly lines depending on which one needed an extra worker, and you don't really keep records of who goes to what and who does what, then that wages becomes very much of an indirect cost because you're not able to trace it exclusively to one particular cost object, right? But suppose, it doesn't really specify here, suppose the overtime workers are needed entirely for one particular cost object, right? And they're entirely directed to that particular group of assembly lines, and it would be a direct cost. So we don't really have enough information to be conclusive here in this case, okay? So in the rare situation that you're faced with this kind of question on a test or an exam, normally it does not happen, but in the rare situation that you feel that there's some incompleteness in the information, here's what you have to do, okay? You specify the assumption that you're making about what you think the question is telling you, and then you tell me what your answer is given that assumption. Okay, so then what you're going to be assessed on is your answer reasonable relative to your assumption. Okay, everyone understands this. So if you were here in this example to sketch out the two scenarios, okay, and then to tell us under this scenario it would be direct, under that scenario it would be indirect, that would be the exact right way of thinking about it. Another question? Okay, the annual fire insurance policy premium for the UMI plant, indirect. Okay, so now you guys are confident with this classification? I think so. So there's one more example. Okay, there's one more example, and I want for us to look at that too, and then we'll try to see if we can finish talking about everything else. Okay, this is a little bit more of an involved example. Okay, so let's first read the information it's given. Okay, so this is a service sector example. Okay, Consumer Focus is a market research firm. You know what market research is. It will tell you in a few sentences. That organizes focus groups for consumer product companies. Okay, so a focus group is really, suppose I'm Apple, okay, and I'm thinking of releasing a new product, the iPod or an iPad or something like that. Obviously, before I roll out a full-scale release of the product, I'm going to test it on small groups of consumers from various different types of markets. I'm going to test it on one group of 18 to 25-year-olds, another group of 25 to 35-year-olds, and get feedback from them. Typically, companies go through many years of this kind of testing and feedback before they finalize a product. So this is what the company does. So it organizes these focus groups and runs them for other companies. Okay. Now each focus group is 8 individuals who are paid $50 per session to provide comments on new products. Okay. 8 times $50, $400 to each focus group. The focus groups meet in hotels and are led by a trained independent marketing specialist hired by Consumer Focus. That would be you guys after you graduated with a degree in marketing. Each specialist is paid a fixed retainer to conduct a minimum number of sessions and a per session fee of $2,000. Okay, let's look at that. It's paid a fixed retainer. What does retainer mean? Sorry? What does the word retainer mean? Now, it just means salary, okay? So each specialist gets some fixed salary for the year, okay? And then they get basically a commission of $2,000 per session. Everyone understands how this works? There's a fixed component and then there's a commission component, okay, that's paid on a per session basis. A consumer-focused staff member attends each session to ensure all the logistical aspects run smoothly, okay? Now, what is the cost object? The cost object is each individual focus group, okay? So let's assume that consumer focus runs, say, 100 focus groups every month. We are looking at one particular focus group. Okay, you can imagine it to be the focus group for some company, for Apple, for iPad, or something that makes it easier for you to think about it. Okay, so payment to individuals in each group to provide comments on new products, direct or indirect? Direct. The annual subscription of Consumer Focus to Consumer Reports magazine. So what is Consumer Reports? It's a magazine that reviews new products. Okay, clearly an indirect cost with respect to each individual focus group, right? Because this is like, again, like supply. Phone calls made by Consumer Focus staff to confirm that individuals will attend a focus group session. Records of individual calls made are not kept. So direct or indirect? So think about the way in which this cost is generated. Okay? Now, it says the records of individual calls made are not kept, right? So visualize this to yourself in the following way. There's a secretary who's in charge of general administration and coordination. Every day she gets a list of all the groups, and she's making phone calls to make sure that everyone's going to attend. And you get a phone bill at the end of the month. Okay? That's the way in which the cost is incurred. Okay, so now tell me, does this sound like indirect or does it sound like direct? It is an indirect cost. Now, what if records of individual calls made were kept? It may be direct in that we don't know. We don't have enough information in order to be able to classify, right? But given this context, given the description, it sounds more like an indirect cost. Okay? Okay, this is an important one. The retainer paid to the focus group leader to conduct 20 sessions per year on new medical products. So this is the fixed salary that's being paid to her. Let's imagine she's paid $60,000 for the year. Okay, so we're looking at this number. Is it a direct cost of each particular focus group, or is it an indirect cost of each particular? Anyone is doubtful about this? You shouldn't be. Okay, it's an indirect cost because clearly the entire cost is not being incurred for the particular focus group that we're looking at. It is very much of a joint cost because we're paying her to conduct all of those groups in that particular year. I think you guys are getting the hang of this, so I just want to talk about a couple more. Let's look at the last one. The gasoline costs of Consumer Focus staff for company-owned vehicles. So remember that a Consumer Focus staff member attends each session, right? So they're driving up and down company-owned vehicles. Staff member submits monthly bills but no detailed mileage breakdowns. What does it sound like? It sounds, given the description, given the context here, it sounds more like an indirect cost. Okay, so a couple of things that I hope you realize from this discussion. Really, the only way to get comfortable with this classification is to look at many, many different examples. So take each of the scenarios that we looked at today in class and try to imagine to yourselves more examples of what would be direct and what would be indirect costs in each setting. Okay, and then if you have questions about something, you can bring it up next class and we'll talk about it. Okay, the second point that I want to make, if you look at the definition of direct and indirect that's given on your handout, let's look at the definition. So the direct costs of a cost object are related to the cost object. That's what we have here first. Can be traced to the cost object in an economically feasible way. But the indirect cost is it cannot be traced to the cost object in an economically feasible way. What does economically feasible mean? What does it mean? So, yes, there cannot be, so what makes a cost indirect really is that it cannot be broken down and associated with each cost object in a relatively easy way. Whereas a direct cost can be associated with individual cost objects in a relatively easy way. That's what economically feasible means. Okay, so if you go back to our original example with the bistro, let's look at cleaning and maintenance supplies. Okay, we put that as an indirect cost. Now, suppose you really wanted to be able to break that down into a direct cost. Well, then you could ask your cleaning lady to account for the cleaning supplies for every single part of the restaurant separately, if you wanted, right? And that way you would be able to break down. But really, in most organizations, particularly in that example that we looked at, it's not worth the trouble of doing that, right? Because that amount itself is not very big and so on. Another example is, if we were to think of electricity, we didn't put that on here, okay, something that we should have put on here. So the electricity bill that the restaurant pays at the end of the month would be an indirect cost of the cost object that we looked at, right? Because our electricity bill is a facility level cost. It's paid for the entire facility as a whole. But suppose we really wanted to break that down and make it a direct cost. We could. How could we do that?
You run a separate line.
Yeah, you basically run a separate meter for every single power outlet, right? So really, if you think about it, the distinction between direct and indirect costs is not a natural one. It's a man-made distinction, and it's a distinction that exists because somebody made the decision, hey, look, it's not economically feasible. It would be too expensive and too much trouble for us to try and break down this cost into smaller, more specific, more individual components. Okay, so it's not that's what I mean when I say it's not a natural or an inherent characteristic of a cost. It's only a characteristic that a cost takes on because an organization is set up and run in a particular way